Hello and welcome to this Edison audio interview. I'm Joanne Collins and I'm joined today by Alasdair McKinnon, Investment Manager of the Scottish Investment Trust. Alasdair, thank you for joining us.
Thanks very much, Joanne.
You've been making some significant changes to your portfolio recently, but before we go into the details, perhaps we can start with some background. Could we start by you sharing your view on the global economic outlook and the outlook for the stock market now that vaccines are rolling out?
Oh yeah, thank you. Yeah, very interesting topic. Well, look, I think it's been, if we look over the last 12 months, what an extraordinary year it's been. We've had things happen that no one, I don't think, could have predicted with accuracy a year ago. Where we are now, though, is we've got the most incredible stimulus from governments in place in terms of cash handouts, preserving jobs, and extremely low interest rates. And that's being combined with an apparent return to some form of normality, prompted by the rollout of vaccines, but also prompted by a sort of change in the mindset, because I think the vaccines is obviously great news, but I think there's probably now a mentality that the world is going to try and reopen now and manage COVID, because it sounds like COVID won't ever go away as such. It will be something that will be required to be managed. So it's almost that vaccines have prompted a change in approach. So what we see looking forward for the stock market and for the economy is we see this for this stimulus, two things. It's going to put an awful lot of cash in people's pockets. Not everyone's, of course, but a lot more people than, say, the last 10 years. And they're probably going to be looking to spend that. It's going to be highly inflationary. And what do we think that means for the stock market? I think it's going to be interesting. We think the current hot area of the stock market has really been the technology and disruptive themes of the market. They've well loved, they've done extremely well, but you've just had a year where you couldn't get any better. You know, if you, for example, were watching a video streaming service at home, if you didn't sign up last year, you're never going to sign up, sort of thing. But now we might just see that shift into the stocks that have really lagged very badly for a number of years. You know, from oil companies to banks to, say, restaurants, retailers. These were things that were all crushed in the pandemic, but now we're perhaps getting the signs of an upturn.
Central banks seem quite relaxed about the risks of inflation at the moment. Are you?
Well, you know, I do read that central banks are relaxed about inflation, but we're not as relaxed about that. And the reason is twofold. One, the central banks, while they're saying they're not worried about inflation, have basically said they're going to let inflation run hot. Why are they doing that? Because they have to. If they normalize interest rates just now, for example, it would crash the economy. The economy is still, rightly or wrongly, on life support. It requires huge injections of money to keep people in jobs and keep the whole system running. The second thing is, I think central banks also realize, as do many other people, that the real way to deal with a growing debt burden is to inflate it away. And I think that is genuinely a long-term plan. So central banks have got a balancing act. I think they really want inflation. They can't obviously say that publicly. They'll not want inflation to get runaway because that creates its own problems. But nonetheless, that's what we're looking at. And you know, even just looking at the stimulus in the US this year, there's very good grounds to suspect it could be highly inflationary this year, never mind on a longer run time frame.
So these portfolio changes that you've made recently, what's prompted them?
Well, really, I think the thing that's prompted them was we think there's been a change in the outlook, particularly prompted by the vaccines and that change of sort of psychology in how to approach COVID. If you look at our performance over the last year, or 12 months or so, we were very well positioned coming into the pandemic. And for an investor like us that sort of invests in the out of favor things, that was unusual because our bread and butter normally is in out of favor stocks, and you know, we're looking for them to recover. So pre-pandemic, these stocks had already been crushed just because of the way the stock market was acting. So for us to exit a lot of those stocks was quite a big deal for us because, you know, it was almost saying, you know, we don't think these stocks will recover with the prospect of this lockdown coming. So that was useful. But where we didn't come November, when the vaccines came in, we'd been too conservative over the summer. We hadn't bought back enough of those stocks. And, there was a move in November that we didn't participate in as much as we would have liked. But after the November move, things started to come back a bit, and in the sort of stocks we like. And we looked at the outlook, as we say, the highly inflationary outlook we see, the highly stimulatory outlook we see as well, and thought, look, there's a number of names here that look like that they're no longer a hugely risky bet. They now look a very reasonable risk-reward bet, so to speak. So we made some shifts. We've sold some of our what were good value stocks, but were, I guess, defensive in nature, not as likely to participate in this flood of money that's going into people's pockets. They might offer good dividend yields, but even they are slightly under pressure with bond yields going up. And we bought a lot of the stocks that are much more exposed to this sort of recovery in the real world, so to speak, as opposed to the virtual / technology world. So that's things like banks, restaurants, retailers, oil companies being another one as well. So that's what prompted it. But we've kept our gold miners. Now they were, again, if I look over the last 12 months or so, they were coming out of the pandemic. They were tremendous, tremendously good, because people saw the prospect of all this money printing, and they saw the prospect of massive inflation. What happened, though, probably in November in particular, was people said, hang on a minute, if I want to participate in an inflation trade, I can do that holding the recovery areas of the market rather than gold miners in particular. But we've held on to them because we think actually these gold miners are the cheapest I've actually ever seen the gold miners be. They're cheaper than the overall market. They've got good dividend yields. And the prospects for gold looks really, really good over the next decade or so. We really are in a period where the money printing is going to be off the scale. And our central case to gold, the gold itself, is that it just keeps up with the money printing. We don't see it as a defensive asset. We see it as an inflationary asset, something we see it as basically a currency that you can't print. So that's what prompted the changes. A more optimistic outlook we see looking forward.
And you've been increasing your gearing as well.
Yeah, just slightly. I mean, it's more a function of the changes we've made. It's not really an explicit view that, as to what we think the overall market levels are going to do. That's always quite difficult. But I think it's an indication of the number of ideas we see currently that look really quite interesting.
And it's been about a month now since you've completed the portfolio restructuring. Have the changes had any impact on performance so far?
Well, look, a 1 month time frame is, very difficult to judge anything over. But I suppose in terms of there was a slight element of good timing to it, because that was when the wider market's mentality seemed to shift, seemed to make a second shift in the last 6 months or so. And now, if you look at the overall market, it's been dominated by technology stocks, particularly in the global sense, technology stocks, disruptive themes, ideas with great ideas, but not much actual financial backing behind them, so to speak, revenues, profits, that sort of thing. These boring things, but we think are fundamentally essential. They have been by far the best areas of the market to be in over the last 5 years, probably even longer, the last 10 years. Now, what happened it was probably a twofold thing. One, people started to worry about valuations in that area. And then that means there's a lot of money suddenly looking for a home somewhere else. But secondly, I think there was just a mood that, actually with all this stimulus, with the way, the COVID infection rates seem to be falling in the developed world, at least, we've got the prospect of often at least an attempt to normalize the economy. Now, of course, we'll have to see how it all goes, but people got a lot more confidence in that. We're coming into the spring as well in the Northern Hemisphere, so much more likely that COVID cases will be suppressed just from that natural way people interact with each other. So people saw value in these names much more than they have in the past, but also that sort of wall of money looking for a home in the wider market. Now, I suppose for this, you know, the circumstances in which our portfolio will hopefully do well will be if that rotation continues. And in terms of how we see it kind of going forward, I kind of look back to the dot-com era for a roadmap, because what happened was you had a tremendous period for technology and disruptive stocks and new economy ideas at the time. And what they did was they did extremely well. But then when things started to, people started to rotate away from that, there were these tremendous opportunities in the other areas of the market that were very much unloved. And I think that's very well known. But then what happened was, as the very hot areas of the market started to fall very heavily, the central bankers cut interest rates, which further supercharged the sort of real economy, as opposed to reinflating what had been a bubble in the hot areas of the market. So we, in some ways, see that roadmap developing all over again.
The Trust has a long record of increases in regular dividend payments, and the board has committed to maintaining this record. How is that going to be achieved, given the current dividend environment is still quite challenging in parts of the market?
Well, I obviously can't speak for the board, and it's a board decision as to what the company does with dividends. But you know, the board have been very clear in the past that we've got a tremendous track record of dividend growth, and we've got an objective to grow the dividend ahead of UK inflation. And we are very proud of these track records. The dividend environment overall is improving. You know, it's not quite back in all areas to where it's been, but looking forward, we're on a path to recovery. So and also the sort of areas we invest in tend to have a higher than average dividend yield. Maybe not so much this year because the companies cut the dividends in the pandemic. So it's not as clear cut as usual, but the areas of the market we are in tend to have a higher than average dividend yield, which supports our overall dividend policy. And lastly, I suppose the Trust has revenue reserves of about 2.5 years. So it just is a support to the overall dividend policy. But as I say, I must stress, it's clearly a board decision, and the board will always take all the environment into account at the time.
And finally, what's the one key message you'd like to leave with our listeners today?
Well, I would say I think there's a tremendous opportunity. The market's almost split in two, and I think there's a tremendous opportunity just now in the sort of unloved areas of the market. This is almost the first time in years where I sort of feel, gosh, you know, this is really exciting, you know, to see how out of favor these stocks are compared to the overall market. So I think if your listeners have that mindset, that would be a very interesting journey for us to go on.
Alasdair, thank you very much for your time. And thank you everyone for listening. Goodbye.
Thank you.